Hi, I'm Jen. Today we are identifying and understanding investment options, including retirement planning, long-term and short-term investments, and dividend reinvestment plans. Understand that investments put principal at risk. Investing is primarily about using the capital markets to invest surplus cash for the longer term. As in the money markets, when you invest in the capital markets, you are selling liquidity. Bonds and bond markets. Bonds are debt. The bond issuer borrows by selling a bond, promising the buyer regular interest payments and then repayment of the principal at maturity. If a company wants to borrow a little, it could go to just one lender and borrow. But if the company wants to borrow a lot, it may be difficult to find one investor with the capital and the inclination to make a large loan and willing to take a large risk on only one borrower. In this case, the company may need to find a lot of lenders who will each lend a little money. This is done through selling bonds. A bond is a formal contract to repay borrowed money with interest at fixed intervals, often referred to as the coupon. Corporations and governments, such as federal, state, municipal, and foreign, borrow by issuing bonds. The interest rate on the bond may be a fixed interest rate or a floating interest rate that changes as underlying interest rates or rates on debt of comparable companies change. Stocks and stock markets. Stocks, or equity securities, are shares of ownership. When you buy a share of a stock, you buy a share of the corporation. The size of your share of the corporation is proportional to the size of your stock holding. Since corporations exist to create profit for the owners, when you buy a share of the corporation, you buy a share of its future profits. You are literally sharing into the fortunes of the company. Unlike bonds, however, shares do not promise you any returns at all. If the company does create a profit, some of that profit may be paid out to owners as a dividend, usually in cash, but sometimes in additional shares of stock. Or the company may pay no dividend at all, in which case the value of your shares should rise as the company's profits rise. But even if the company is profitable, the value of its shares may not rise for a variety of reasons. This is having to do more with the markets or the larger economy than with the company itself. Likewise, when you invest in stocks, you share the company's losses, which may decrease the value of your shares. Mutual funds, index funds, and exchange-traded funds. A mutual fund is an investment portfolio consisting of securities that an individual investor can invest in all at once without having to buy each investment individually. The fund thus allows you to own the performance of many investments while actually buying and paying the transaction cost for buying only one investment. Mutual funds have become popular because they provide diverse investments with a minimum of transaction costs. In theory, they also provide good returns through the performance of professional portfolio managers. An index fund is a mutual fund designed to mimic the performance of an index, a particular collection of stocks or bonds whose performance is tracked as an indicator of the performance of an entire class or type of security. For example, the Standard & Poor's 500, or S&P, is an index of the 500 largest publicly traded corporations, and the famous Dow Jones Industrial Average is an index of 30 stocks of major industrial corporations. An index fund is a mutual fund invested in the same securities as the index, and so requires minimal management and should have minimal management fees or costs. Mutual funds are created and managed by mutual fund companies, brokerages, or even banks. To trade shares of a mutual fund, you must have an account with the company, brokerage, or bank. Mutual funds are a large component of individual retirement accounts and defined contribution plans. Direct investment and dividend reinvestment. Direct investment and dividend reinvestment are ways of buying shares directly from a company without going through a broker. This allows you to avoid brokerage commissions. Direct investment means purchasing shares from the company, while dividend reinvestment means having your dividends automatically invested in more shares rather than being sent to you as cash. Dividend reinvestment is also a way of building up your equity in the stock by reinvesting cash that you might otherwise spend. The advantage of direct investment and dividend reinvestment are primarily the savings on brokerage's commissions. You can also buy fractional shares, and there is no minimum amount to invest, as there can be with brokerage transactions. The disadvantage is that by having funds automatically reinvested, you are not actively deciding how they should be invested, and thus may be missing better opportunities. As opposed to saving accounts and certificates of deposit, investments put principal at risk of being lost, and risk needs to be weighed against potential reward and your own personal risk tolerance.